Let's welcome on board Ashish Somaya, the CEO at White Oak Capital AMC. And Ashish, thanks so much for joining us. First up, give us a sense what you are making of the markets right now, because we've seen a little bit of a correction, or rather some profit booking over the last two trading sessions. But today seems like once again the bulls are back in action. Do you believe that this little bit of a profit booking that we had seen was just a temporary blip, and now that the correction that we have been seeing over the last couple of months is far behind us, are we out of the woods now, and are you only spotting another bull run going ahead?
Yeah, so thank you very much for having me this morning. To come straight to your question, I wouldn't attach much sustainability to what is happening right now in terms of the bounce back that you just mentioned. The reason being that obviously right now, if you ask me, the domestic conditions are kind of improving, but our troubles are all related, and not just us. If you see emerging markets in general, our troubles are related to the US. Because the US for the longest point in time was on a tear. And only in the last 1 month, you've seen the NASDAQ coming down by about 10-12% and the MAG 7 coming down. So the past history suggests that when the US market starts to weaken, in sympathy, all of us, see quite a bit of volatility. Medium to long term, US market cooling off might benefit us, but at least in the near term, from time to time, we will be caught in the throes of their volatility. And from that perspective, I wouldn't attach much sustainability to what is happening right now. I mean, if we see an uptick, we will again see some other news flow or something coming, and again, the market probably trading down. So I would imagine next 3 to 6 months is going to be 2 steps forward, 1 step backward, and not much direction according to me.
And point taken, like you said, India could be caught in the crosshairs of everything that's been happening globally. Amid a situation like this, we're soon approaching the 2nd April, 3rd April deadline also for all of these tariffs. Last night, you've also had the new auto tariffs being announced. Amid all of this global volatility and uncertainty, which sectors do you believe are going to be the most hard hit, and where can investors find some safety net amid a market like this?
On to long term, or maybe you can say a year or so, for people to figure out the real impact. Because you can see, like so many things are thrown up in the air. It takes time to figure how it eventually lands. Plus, also, it's not just about India. It's also about, let's say, if we are worse off, then how worse off are, say, other trading partners or other emerging markets? Because then, there is all this relative, equations that kind of tend to throw up themselves. On your question, while a lot of these, like you mentioned, auto ancillaries, similarly, there will be some of the other sectors for the next few weeks, which will again, come into question or come into discussion. So from that perspective, first is that I would be conservative about the markets, and I would not suggest anybody to kind of straight away jump in the next 3 to 6 months. We have been consistently telling people that this is a time to review your asset allocation. The reason why I'm saying is because last 3 to 4 years there was a significant up move in a certain segment of the market and certain bunch of sectors. Now, what has gone up a lot in the last 3 to 4 years is what has actually fallen the most from September onwards. And my sense is that if the market starts to do well, a different bunch of sectors would lead the up move. So if people are kind of stuck with certain segments of the market, this is a time to review and rebalance. And on your question about where one should be more significantly weighted right now, if you look at our portfolios, like you've been flashing on the screen, we are overweight financials. When I say financials, not just the banks, it is also NBFCs and across capital marketplace. So the top holdings are typically private sector banks, but also NBFCs and the larger capital market space. The second one, where we are significantly overweight by a significant margin compared to BSE 500, will be discretionary consumption. So these are two significant overweights in our portfolio. Other than that, of course, there is a significant stock-specific active weight that is there. But sectors, if you ask me, other than financials and consumer discretionary, we don't have very significant overweights in any part of the market.
Right. Ashish, Cheryl also joining in the conversation. Just speak about the sectors that you're liking, and I think it's a consensus move that everyone loves banks and financials at this point in time. But you did speak about the fact that this is the time that you need to relook at your asset allocation. So when you talk about that, are you talking about one can look at debt, they can look at gold as well, be diversified so that you can diversify your risk, because most of them were very heavily overweight on equity, and I think that's one of the reasons why the pain has been sharp, because your asset allocation has been so much skewed towards equities, because in the last 4 years you've not seen such a sharp downturn.
Yeah. So, I will speak at both levels. When I was first answering, I was alluding more to within equity, which way are people really allocated. Whatever I understand is that, if you say within equity itself, in the last 3 to 4 years, everything that was cyclical, everything that was linked to public policy or to macro turn of events, all of those macro linked sectors, public policy linked sectors, everything which is cyclical, and wherever the orientation of government policy is, those are the stuff which really outperformed. And anything which was linked with, say, good governance, free cash flows, a lot of those things were actually underperforming. Now, when the market falls, and when the market, again, like last few days, after a fall, when market shows signs of recovery, I have seen this overwhelming tendency for people to average, wherever they have fond memories of the previous cycle, they tend to average that because that is what has fallen a lot. Now, in my learnings, that's not a great strategy. That's why I said that, if your portfolio is overweight, what was working in the last 3, 4 years, you need to rebalance in favor of probably the new winners. And according to me, new winners are usually the ones which fell least when the market was falling, and not the ones which fell a lot after running up a lot, right? So that is the rebalance or reorientation I was talking. It's more within equity kind of thing. Coming to your question, definitely, even the overall asset allocation, one needs to look at it. The reason being that, if you see from here on, there is definitely an expectation that yields will go down, fixed income will tend to outperform. And before your question, I was mentioning next 3 to 6 months, market will have many disturbances from the external sector. And, if the US economy is expected to slow down, and if, globally, the economy is supposed to have uncertainty, then gold also would remain in play. So I was talking about allocation at both levels. And the third thing, which is also very relevant to note out here, is that in the last 6 months, you can clearly see that, a lot of direct equity portfolios are down by about 40-50%. But on an average, a diversified, say, flexi-cap fund was at the worst point in down by about, say, 15-16%. So in this fall, the third aspect is also that managed portfolios have significantly outperformed, because managed portfolios which have a benchmark and which have some investment universe or a scheme of a document, they have to toe a certain regulatory diktat. They don't tend to get tilted in favor of what's hot in the market. So even diversification has really helped in the recent times.
Thank you so much for actually clarifying on that, giving us the real sense of what you meant when you talk about diversified asset allocation, especially within the equities. But Ashish, I wanted to ask you, and since I have you here, how can I now ask you about two topics? One is IPOs, the other one is SIP. IPOs, actually over the last few months, we've seen that pace of IPOs actually reducing quite a bit, given the fact the boom that we had in September 2024. Now that sort of is, I think there's some sort of semblance come in when you talk about, or sanity come in when you talk about the IPO market. And the other one you talk about is SIP. Now we have actually come down from those record high levels for SIP inflows, and you are seeing redemption pressure also on that particular front. How do you address both of these markets, because both of them were flying high at one point in time?
So, first on the IPOs, I have a short-term picture and then a long-range picture. I think that if you ask me short-term, yes, clearly, IPOs do get impacted with market sentiment and people's willingness to evaluate new ideas and allocate aggressively. So definitely IPOs do, the activity gets subdued. But I have a couple of other points to make. I really, if you ask me personally, I would welcome more IPOs in the market. You must have seen that there are some fabulous companies that have got listed in the market. The other thing is, I have been in the industry 25 years, and since I started, people have been forecasting that India will someday become a middle income country, and someday, the market will become big, etc.
Ashish, agree with that view coming in, and appreciate you sharing your views on the outlook and as well as on the primary and secondary markets going ahead. And on that note, we'll let you go. Thanks once again for joining us.
If you like this video, then like, share and subscribe to ET Now.